Being able to access your pension can be a really valuable benefit, but making one-off pension withdrawals could result in an overpayment of tax, which you will want to reclaim, of course. This is because these one-off pension pot withdrawals are taxed on something called an emergency basis. Recent figures from HMRC show that in the 2021-22 tax year, there was a record year for flexible pension withdrawals with a total of £10.6 billion. Taxable income being flexibly withdrawn, up more than £1 billion on 2021. And in this first 3 months of this tax year, £3.6 billion has been taken, a 23% increase in the same 3 months last year. So what are the consequences of flexibly accessing your defined contribution pension pot? Why does it matter, and how can you be certain you're going to be receiving the amounts that you want and need after paying something called emergency tax? Well, let me start by explaining what emergency tax is. When a taxable income is taken from a pension, the pension provider must deduct tax through the application of PAYE, which is much like an employer does. However, the first payment is a problem as the pension provider won't have a tax coding to apply. So HMRC insists they apply for emergency tax code on a month one basis. The emergency tax code is applied because the pension scheme doesn't know what income you've already had in the current tax year, and therefore what tax code you have. So the emergency code will allow the application of the standard personal allowance, which is £12,570 for this tax year, and the normal tax bands. However, it is the month one basis that can produce unexpected results. The PAYE system was designed so a regular income can have a known amount of tax deducted each and every month throughout the year, so without large spikes, or so the correct amount of tax paid is paid by the end of the tax year. But the system doesn't cope well with initial payments and ad hoc payments. The first flexibly accessed income payment and any subsequent ad hoc payments are taxed on this month one basis. This means that no matter which month of the tax year you take a withdrawal, it's treated as if it's the first month, and so the payment only gets 1/12 of the personal allowance and tax bands. It's going to be easier for me to talk through an example to illustrate how the month one tax rule is applied. So we've got a guy called Steve. He lives in England, so it's the England and Wales tax rules, and he's self-employed. And due to the current world conditions, he's experienced a drop in his profits from his business. Combined with maybe higher inflation and rising costs, he's struggling maybe to pay his bills. Steve's over 55, so he's considerably taking advantage of the flexibility his pension offers and to withdraw some funds to cover his current shortfall. He hopes this is going to be a short-term need to tide him over his current circumstances, and that this is not going to affect his retirement too much. So Steve's income from self-employment this year is estimated to be about 35 grand, and he needs about another £17,000 of net income to cover his expenses. So he thinks that if he takes £20,000 out of his pension through Flexi Access drawdown, that's going to give him £5,000 in tax-free cash, 25%, and £15,000 of income taxed at the basic rate of 20%, leaving him a net amount of £12,000. So £17,000 altogether, which would cover his shortfall. However, as this is the first time he's taken any income from his pension, the scheme is going to apply emergency tax on the month one basis. This means that 1/12 of the personal allowance, his personal allowance, will apply, giving a certain amount of tax free. Then 1/12 of each tax band will apply to the balance of the payment. So even though Steve is going to have £15,270 of the basic rate band available based on his annual earnings, his pension scheme has no knowledge of that. So as a result, part of his £15,000 taxable pension income will be taxed at the higher rates of 40% and 45%. Steve will therefore receive a total of £14,975 from his £20,000 withdrawal, being made up of an income after tax of £9,975. So that's £15,000 less the £5,025 plus his tax-free cash of £5,000, leaving a shortfall figure of £2,025 on his target figure of £17,000. Steve can, of course, reclaim this shortfall, but that can take him some time. And if he needs the money urgently, it might lead to him making a further pension withdrawal, which of course isn't really necessary. So what could he do? Well, if he's not desperate for the money, he could crystallise just the amount he needs to give him the required net income, then apply to HMRC for a refund. If he needs the money more urgently, he could consider setting up smaller regular withdrawals over a longer period of time. The first payment may still be overtaxed, but the scheme should then receive a tax code to apply to future payments, which will provide greater certainty of net income levels for the rest of the tax year. Beware that if you're a higher or additional rate taxpayer, the month one emergency tax code can sometimes result in an underpayment of tax, but this is normally collected by a small adjustment in your tax code by HMRC. One major thought is if you're thinking about accessing your pension flexibly earlier than you'd planned, of course, is the money purchase annual allowance, which is triggered the moment the first income payment from Flexi Access drawdown is made. I'll do a video on that exact topic, which should come out tomorrow, so hit the subscribe button to be notified about that. You know, in these uncertain times, it may be very tempting to consider making an early withdrawal from your pension pot to cover an income shortfall, but make sure you fully understand the consequences. It can be tricky to get exactly the amount that's needed, with an increased tax liability up front and potential issues for rebuilding your retirement savings. Thank you so much for watching. I hope you've enjoyed this video. If you have, please press the like button now, and of course subscribe to the channel. I'm Justin King. I'm a chartered and certified financial planner, and my aim is to help you live a successful life. That often involves understanding your money. I host a podcast called the Retirement Cafe Podcast. You might like to tune into that. I'll put a link again in the description below. Of course, you could also sign up for my weekly newsletter, which is packed with inspiration and tips for a successful retirement. For now, I'm Justin King, helping you live your best life.